big picture, we know what's coming down the pike, right? I mean, we know that there's JPM on Friday. That's going to be a big deal. Only because there's 39,700 short calls sitting out there. And they will just continue to grow in importance. I think, let's just do it this way. I'll open up the PBI. Can everyone see my screen, by the way? Just making sure.
Yep.
Okay. Yeah, so, I think, now this is Friday's data.
I cannot see your screen, please.
You cannot see my screen? All right. If you go to the voice, you should be able to click on GE Paul, and it should make it live. I never watch myself, so I don't know if there's nuances in that. Everybody else see my screen? Just making sure I'm broadcasting. You should be seeing.
Yep, I see it.
Okay, the PVI chart. So this is updated for whatever time, right? So where we closed on Friday. What I wanted to show you is just really the dominance of the 30th, right? So this big line in preparation of what's coming this week, this is just going to continue to grow in the absence of long calls stacking on top of it. So there are a number of long calls on it. Remember, this is 37,900 short calls that JPM is holding right now, and those are not liquid. I know people say, well, wait a minute, they're in the money. Aren't they doing something with them? Aren't they getting rid of them? No, they're not. They are long the portfolio, and when you're long the JPM portfolio, it basically operates as a covered call. So what that means is the risk has been shifted to the people who have bought into the JPM fund, and JPM's not going to do anything with these things. Now, all of that being said, it's probably interesting to kind of look through on the Friday to look through what is really going to happen here. And so what we saw at the end of March and what we saw at the end of December and et cetera is that the market tends to pin towards these large strikes, and this is by and large the largest strike that we have to contend with. As we get stretched above this, and we have to assume that the dealers are hedged right now, so they're more or less flat. And what happens as we get stretched above this, there's a natural reaction for the dealers to sell, and that'll push us back down towards it. And then as we drop down below it, because these deltas will shift pretty quickly, there's a natural response of the dealers to have to buy as their book gets shorter and shorter. And then, boom, we're pushed back up towards this thing. So that pinning mechanism that we're seeing, I think one of the takeaways for the week is that we should remain in this area, all things considered. We should remain in this area. Now, how far we can go one way or the other, that's given by the day-to-day structure. But this large gamma that is sitting right here is significant. It's noteworthy, and I think it's something that if you have been watching it for a while, you probably have an opportunity to structure something around here. So how do we make money from this? I think this is probably the first question that always comes up. So as the price moves up, and let's just say it moves up the chain, I would use the opportunity, if you can, to pick up some very low-cost opportunities to play the convexity to the downside. Now, there's a number of ways to do this. I see Tom is on, Tom Lay, and They're
It'll just freeze for me, or is that for everyone?
what do you mean? It's for everyone, actually. But I see Tom Lays on, and Tom, feel free to hop in here if you. Well, there we go. Tom just threw something in an option strat, and we'll go look at this right now. Yeah, spreads would be. Jonas, I agree with you. I think spreads are a great way to play something like this. I think let's just go take a look real quick and see what Tom's thrown at us. So it looks to be, let's see, playing a very narrow, very narrow, right around this, almost. Let's see, we're short a put at the 25, and short a call at the 20, and then long the 20. And if you look at the dates, so it is of a to think of this in a way, this is kind of a diagonal because of the difference in strikes. So the calendars are separated. It's not a calendar, but it is gives you this kind of behavior. So as we slide through time, if we do migrate down below, you can see what happens, right? And if we do happen to pin, it'll be payday, because it'll cost you $30 for this trade using, the markets are closed, so spreads are going to be a little off right now. But it'll cost you $30 to put the trade on. So, ponder that, and, your payoff could be fairly substantial if for a single contract here. Yeah, the debit is irrelevant. You're leveraging 500 margin, but on both sides, yeah, exactly. So, nice 3-to-1. This is just a nice clean setup. This is one way to do it. A spread, obviously, you could do a debit spread, and I know Tom hates those. I know Doc loves those. I would, there's a number of ways to probably structure something like this. So I think for the week, again, just looking back at, what we're looking at, this is the full PM structure. The low side is going to be around the 43.20. You can see there's not a lot below, although there is a hiding zone right down here. This is the PM structure. And then to the north, you can see the 44.40 is the dominant line. And, right here, the 43.75 is another dominant line. If we flip over to the overall SPX combo, the combo complex, it just like we were saying on Friday, the 4,500 is indicated. We've got a lot of green deltas above, so these are the out of the money calls that are dominating above us. This 43.65 right here that you see with this red delta, this is the end. This is due largely to the end of July, not end of June, end of July JPM strike. So that's something is something to pay attention. And then here's that JPM end of next week, or this week, the 6:30, already starting to rear its head in the combo complex. So, stepping back, one of the first things that I do when I look at our gamma charts or look at the 3D delta charts is I want to see, for all intents and purposes, I want to see what's the horizon look like. Are we out of the money call dominated? Are we in the money call dominated? And the answer to both of those for the SPX combo complex is yes right now. We're still very, very much dominated on those sides. I think, it could be a bit, the favorite term over the last couple of weeks has been a drunken sailor. I haven't looked at what the news cycle is going to be this week. It's going to be whatever it is. I'm of the mindset that as Friday gets near, this thing's going to rear its head. And the 30th, you can see you just got quite a bit going on here. Still have 18,000 contracts net that are net negative here. So they've been stomped on by about 20,000 long calls just on the 30th. So, but it's not enough to neutralize it. So let's go back to our discussion that we had at the end of March. At the end of March, 4065 was the JPM strike. And for those of you who were playing the game with us, we thought we were going to pin around the 4065. But the day before and the day of, we raced right through it like it was a hot knife through butter. And one of the reasons that we feel that occurred is that watching value that day, effectively, we negated the 4065. They were pounded into submission to where that the JPM gamma effects had been neutralized by long calls. And then we started pounding the 4100s all the way on up throughout the day. And that just pulled us north. If you open long calls, certainly above where the short calls are, you're going to get pulled towards that. I mean, the opening and closing of the deltas it absolutely overcomes anything that Gamma is going to provide us or Charm is going to provide us. The opening and closing of deltas reigns supreme. That's a rule. We haven't gotten into the math, and we don't need to get into the math, but happy to get into the math. But if, delta was 0 to 100, gamma is, 0 to 5, 0 to 10 maybe, charm even less depending on how you look at it, and Vanna, they have an effect, but they are not enough to overcome delta change. Delta is a first order Greek, and as a result, it rules the table. So just everyone remember that. Opening and closing, and you can watch that with the value command. Opening and closing a contract will have far more impact than any of the second order Greeks. So when you want to criticize us and others about, gamma didn't work or whatever, first question that you should be answering, what was the change in delta around those strikes? If it was pretty substantial, that's what's going on. So hopefully that's useful.
Quick question going back to something you said in the beginning. As we move away from that 4320, right? So the dealers are long there. As we move away, their deltas, don't they have to buy more to compensate, not less?
Well, let's go back to let me see if I can find this old presentation, and maybe I can help explain it a little better. This is not set up for this particular session, but it'll help give us a view into the March 31st expiry. And so let's back up a little bit, just so that we can get kind of a lay of the land of sorts, just so everyone kind of knows. Now, again, this is March 31st. This isn't this one. I wasn't planning on spending a lot of time on this tonight, but this is a good time than other to talk about it. So the JPM hedging structure looks like this. Whether it's March 31st, I mean, the strikes will be different, but the shape is the same, right? So that's the important thing to realize, is that the JPM in a general sense looks like this. And what they do, just for the new folks here, is that if this is spot price, right where I'm showing here on the middle of the screen, what they do is they sell a put debit, or not sell, they buy a put debit spread, and basically the long strike is 5% below, and the short strike is down here at 20% below, or a net 15 below where they did this. So this is 20% basically downside that they have, quote unquote, put in place. And then this is a debit. When you buy something that's closer to spot, you pay more than when you sell something that's further away, and therefore they've got a debit. And that's the way it works. And so what they do is they come up here, and it's generally 3 to 5. Their prospectus says 3 to 5, but we've seen them as high as a little over 6. It just depends on how juicy the premiums are when they do this thing. And what they try to do is maximize the distance here to have a net offset. And so what it looks like is basically no hedging in this area between 1 and 2, and they're protected here. And basically, you give up the gains. They don't care. And I see a lot of people talking about this. Oh, if we're up here and they're short the strike, which is exactly the way we are right now. JPM's feeling heat. No, they're not. It's a covered call. It looks like this. So if you're not familiar with the covered call P&L, this is what it looks like, right? You're long an index or you're long something, and then you've sold a call at some point up here. And when you basically have that structure, anything above that is no gains, because quote unquote it's going to get called away. Now the mechanics are a little differently, but you get the idea of what's going on here. So this is their overall risk profile. And so what happens is the people who invest in JPM's fund, they get upside 3 to 5, they get downside exposure 5%, and then they're flat. So if the market collapses more than 5%, they're basically protected. Why are they protected? Because they've got this, at the limit, they've got this terminal P&L, which basically compensates where they're long. So as long as they're correlated, and they are, they're long the stocks of the S&P 500. You can go to their prospectus and look all that up. And basically, you get what you get. Okay, now with that background said, let's take a look and just kind of get a sense of what's happening.
Sorry,
here.
Quick question, Paul, please.
Yep.
Can we go to the previous slide that you just did? The one before that. So will the 4320 be the?
It's right here.
Okay.
It's right here at circle 2. Yeah, it's right here at circle 2.
Then where would be the 4400 or?
They don't have a 4400. Yeah, so they what's expiring right now is they've got a 4320 that's expiring. They've got a 3885, which is this one right here, or this one right here, 3885, and then they've got another 3280, which is this one down here.
Okay.
So they're naked. They're naked this call, but it's JPM. They can do whatever they want. It's not like the markets are going to race to the north. And again, remember, they're hedged, right? This is a hedging structure. So they're long a portfolio, and then they overlay this with that long portfolio to take the risk profile here and make it the composite of long stock, or they are long stock, by the way. It's not like long in index. They're long stock, and then it turns into where we are right now at 43.20. It turns into a covered call. And this is what it looks like for them. Okay. Is that helpful?
But how would? Well, they have to monetize on Fridays. So do you think they will pin it lower? Because I'm trying to understand. I'm sorry, I'm new.
No, that's a great question. And
I don't know how they're gonna monetize by staying below. I mean,
they don't. Remember, JPM doesn't care. They've passed all the risk on to the holders. So let's just, for an example, let's just say that price is below 38.20. So they're below the knee. They're on this line. So when they bought, they were profitable up to that 38.20, right? So the fund holders are going to make money, right? They've gained from where they actually bought, which is right here, right where that green dotted line is. That was the spot price that they bought at the end of March. Okay, so far so good?
Yes.
Okay. So now they're up here, and it's just like a covered call, right? So what's different with JPM, and they don't talk about this in their prospectus, but what's different about JPM is if it were you and I, we would get basically, if we were holding the SPX, we would be in trouble because European style, we would have a net debit against a long portfolio. So let's just say we had, so one contract, whatever one contract at its max would have given us, in this particular case, we would have, effectively capped our gains. So we would see a net debit if we are above this by however deep we are. And so our long stock that we have would be capped at this 43.20. by definition, because we have a short call there. So if we had one short call contract, basically they're going to get quote unquote a net debit against their long, and they've got some cash reserves, they've got other stuff, and they also trade. If you read the prospectus, they got futures and they've got other stuff they can do. But what they do is they roll out, and in the rolling process, they actually incorporate some of the expenses of the management and everything. So they're always capturing, and again, JPM takes no risk. I want to just pound that into everyone's belief system here. They don't hedge any risk, or they don't absorb any risk. It's all passed on to the people who subscribe. And so what happens is that if we're below 43.20, nothing's going to happen. The call will expire. The short calls will expire out of the money in this particular case, and they will have no impact. So basically, they'll allow those to effectively collapse to zero. They may have some intrinsic value or extrinsic, time value, but they typically do this at about 3 o'clock in the afternoon Eastern time. There's very little theta left in those calls, and therefore they don't do much with them. They never do. And then they roll out 90 days later, or whatever the next end of the next quarter is, and they pick their strikes just like we just talked about. They go out to a new strike. So if we're up here, just below the 43.20, they'll pick the 5% below, like I was just saying, and they'll pick the 20% below, and that'll be their long side of their put spread, and then they'll collar it by throwing on a somewhere up in this price, whatever this price ends up being, 5% above whatever the spot is Friday afternoon. They'll end up putting a new one on, and they'll have some expenses in there. They'll probably roll after the close. They always do, or 90% of the time they do. And they clean up loose ends, and it's done. It's done. Is that helpful?
Yes, thank you very much.
Yeah, you're welcome. So let's answer Doc's question. Doc is basically saying, what happens if we go around the strike? Now, again, this was the 40.65s at the end of March, but it's the same argument here, right? So if we're below the price, so below 40.65, the short deltas collapse. So this is a picture of the terminal deltas. That's what this blue line is right here. And so basically what we're looking at is that if we're below the short strike, which in this case would be 43.20. If we're below this short strike, in this case it was 40.65 on the diagram, what's happening as we get closer and closer and closer into the end of the week is that the deltas are collapsing. So basically, in this particular instance, we're effectively collapsing all these deltas to effectively zero, right? So when that happens, right, and we're approaching from the minus side. So the JPM side, which is flip of this, right, effectively they're both approaching the zero line, which is right here. We're doing it from one side. They're doing it from the other side. So this is us from the negative side. The dealers are long, as Doc just said, and they're getting shorter if we're below. So in this particular case, as long as the price is below 40.65, dealers are buying because they are basically, in this particular case, they're getting short, they're losing positive deltas, and they have to buy. That action of buying, if we're below price, starts to push us upwards, and this is why we see pinning. This is why this becomes a big number. So let's go to the other.
Let me stop you there. So, but if they're already long delta and they're hedged, and those deltas collapse towards zero, don't they have to sell to equalize their deltas?
No, they don't sell the portfolio. Don't think about the long portfolio here, Doc. Just because they're long stock, and if you look at it, they've got long-term gains on those stocks. So they're long the S&P.
I'm talking about the dealers. The
dealers.
Yeah. Right. So the dealer is long, or let's just say the dealers are hedged, and we're at 43.20, so they're hedged 50 delta. Okay, and we're coming in as it goes below that; those deltas will fall to
40.
Zero.
No, they go to 40, they go to 30, they go to right.
So, and as we're below, and the dealers they're long those
but
deltas.
they're getting shorter. That's the approach. They're basically approaching zero from above, right? So they're actually going 50, 40, 30, 20 as they come on down. And to hedge flat, basically they've got to buy, right? Because they're losing deltas as we get into the decay. Okay? Does that make sense?
Well, no, I don't know why I'm stuck here. If they're already long those deltas, they're long the futures, let's just say,
No.
and
You're making it way too difficult. You're making
okay.
it literally. I mean, with all due respect, let's just say they're long deltas, and we know the deltas are collapsing. They are because of theta, right? So
Then they have to sell to make their deltas
no, because
zero.
they're already going to zero. They're getting shorter. So if I'm hedged and tick tock, I have less delta 5 minutes from now. If I want to hedge, what's happening? I need to buy. If I'm fading towards zero, that's what the green line is showing. I'm fading towards zero. They're fading towards zero, but from the opposite side. Their book is getting shorter. They're losing deltas if they're below the price.
Okay, so they have to, okay, they're losing deltas, so they have to buy. Gotcha.
So they got to buy, and that buying is what pushes us up towards the pinning strike. Okay, so are we clear, Doc? I want to make sure before I go on that you and I are
Yeah,
are
okay,
sync.
I got you. I got you.
Right. So all things equal, as long as the price is below whatever the strike is, in this case it was the 40.65s, but for us we know it's the 43.20s, the dealers must buy to hedge flat. And that's what, depending on what's going on, and there's a lot of market dynamics going on like we talked about before. But let's take the other side of this, right? Let's take now that we're above, right? Now if we're above, what's happening? We're basically those deltas for us are going to -1, right? Short call is like a long put, and we know a long put looks like a -1, right? So basically on our side of the table, our book is getting shorter and shorter and shorter. The dealer's book is getting longer and longer and longer, right? Because the dealer's terminal P&L is flipped, right? They're on the other side of this. So basically what's happening now is that if we remain above the pinning strike, the dealers have to sell. And so as we get closer and closer into this, as they sell, we get pinned. So now this becomes that pinning phenomena on each side of this, right? And gamma's in there, it's accelerating the sensitivity. We've got charm. I think this is effectively, this is how we this is how we're positioned right now. And as we go through the week, I think this is likely, absent what we saw at the end of March, which is where we actually saw the strikes just getting pounded and these short strikes neutralized with long calls. So I think it's very, very possible, going back to the question that we started at the beginning, that for the week, we could see pinning, and the pinning mechanism I just described is the macro pinning. There's all sorts of nuances like Doc was alluding to. They've got futures, there's all sorts of other stuff going on. And remember, if I open up a whole bunch of long calls right on top of this 40.65, or in this particular case for this week, the 43.20s, it's going to make this less impactful. And if I start opening up a whole bunch way up here, whole bunch being a technical term, it's effectively going to neutralize it. And that was something that we didn't expect in March, and it was something that we ended up experiencing. So I think, all things equal, I mean, we'll see what happens at the end of the week, and we always do a post-mortem. I think, I think the big takeaway is it's about structure, and we know what the structure is, right? We know, for instance, that we've got this looming out here, and if we just kind of look at let me just go back, and I'm just going to turn these off so we can just look at what's the aggregate of the week look like. Actually, I should have done this in the website, but that's all right. The website allows us to do this much easier. We'll give you guys a demo here. Not website, web app, I should say. It's not a website. It's just an app. So this is looking basically at the week now, right? So, and this is basically telling us 43.75 for the week is important. There's a little parking spot above it. This will change in the morning with new data. And you can see COI for the week is sitting up here at 4,400. So this is what's expiring this week. And effectively 4,400 is coming off. But until it does, sequencing matters, right? So how we go through each of the week in each of the days, and I'm removing days, you can see this 4,400 remains the same. In fact, the week looks a lot, I mean, it's really consistent. Just let's do this again. Think of a movie here. So I'm going to take away Monday. Not really any change. These bubbles over here, so this is plus gex, minus gex. That didn't really change. Let's look at here. Still got COI over here. Here's that 43.75, 43.20 looming large, right? Take a look here. 43.75, 43.20 again. Boom. Looking here, same thing, and then bam, we're on to Friday, right? So I'm expecting, for all intents and purposes, we may park a little bit above, right? Maybe up to 43.85. There may be some push to play with this 4,400. You can see if you just take delta and gamma off the table, there's a lot of people who are stacked at 4,400. Sure there are. It's the Livermore number. It ends in 00, etc. It's a nice whole number. People love it. I think the other thing to kind of look at is, as we go through the week, where are the hiding spots? And again, the stat will change in the morning, but you can see we've still got, for all intents and purposes, we've still got green deltas above us, right? That's out of the money call speculators. They haven't thrown in the towel yet. And below us, we've got green deltas. That's in the money call speculators. They're present. We're not seeing the put speculators arrive, and they haven't stacked and turned everything red on us. Not yet. It can happen in a day. Watch the value command in the Discord. But through Friday, I'm calling pretty much ping pong between maybe this 43.75, maybe up to COI 4,400, and not much below 43.20 for the pinning mechanisms that we just spent a half hour talking about. So that's my crystal ball for the week. I have no idea if it'll materialize, and neither do you. Hopefully that was helpful. All right, I gotta get caught up on messages. I see you guys. Oh, Panther, good to see you, buddy.
Question: which chart is this? Is this the combo?
Yeah, this is this one is not the combo. This is the PM settled. If I were to bring the combo in, it wouldn't have much because nothing comes off in the AMs in this week. So I just watched the PMs this week. Now, the AMs are present. Certainly they're present. But they don't rear their head until the third week of July. That's a great question, by the way.